Recording in progress.
All right, good morning, everybody. Yesterday during the auctions, there was no takers. Imagine that. I mean, absolutely none. 0 million was the outcome. Zero. Things are getting just a little out of control out there. All right, so as we usually do, we want to start with what happened in the overnight hours. I tend to use Finance Juice for this. On the left sidebar, you'll see a list of anybody who's scheduled to speak today and some of the economic events that are on the docket for the day. I say some because there really are so many events. A lot of them go unnoticed. They don't even hit major news outlets. So, um, maybe look around in a couple of different spots. I was just looking here. This is a bot. I just used the command to get a list of the events for the day. And there's so many of them that it actually needs 2 pages to see everything on the list for today. And yet here, this is just a really small list. I know it says Powell is scheduled to speak today, but it's some kind of luncheon event or something like that. It's not. He's certainly not going to be coming out and giving economic policy. Right now, the market is trying to decide what kind of rate hike we're going to get in November, be November 2nd. If we're sitting at 3, and this is showing 52 for 3.5, then it's saying that the market expects a 50 basis point rate hike on November 2, with a higher expectation than getting a 75 basis point rate hike on November 2. They're pretty close together. They're not very far apart. So the market, still seems to be in this maybe yes, maybe no. If you look down here, the bar doesn't give you any information about, well, where were we yesterday, right? Or where were we last week? The bar just gives you the snapshot of where are we right now. So if you look down, you can see the changes made from yesterday, where it was 48.62, or excuse me, it was 37.62. Now it's 52.48. Right, so it's a part of that adjustment that's going on in the marketplace. The 50 basis point rate hike increased what, 15%? So it's like they're trying to unwind a little bit of that 75 basis points. And generally speaking, when they start to unwind like that, you get this nice little rally in the market. Anybody see a rally there? I don't see it. Nope, I don't see it. There are now a few Fed speakers that are starting to give the little wink wink nod. Maybe we're going too fast. Maybe we should slow down. Maybe we should pause and see what our actions are doing to the market. And that's the first step, right? They start getting into that stupid language where they say we're thinking about, having a discussion about, having a pause. And then it'll be, we're no longer thinking about having a discussion. We're just thinking about having a discussion. Then it goes from that to, we're going to have a discussion. As stupid as that sounds, that's the wink and the nod that we have to deal with. All right, so petroleum status report. There's a lot going on in energy around the world, obviously. And then we have the 2-year and the 7-year today, 11:30 and 1 o'clock. I'm really interested in inventories. This is, well, we'll just see how it plays out. All right, we're coming in a little heavy today on the volume. Normally we run, say about 185 to 215, 230s, 250s. We're in the 300s this morning. I just set this chart over the last 30 days, and there is no 300s in here. Yeah, that's a 2. So we are in it. We are picking up some significant levels of volume this morning. Let's go out to a daily chart. Well, we don't need this anymore. It did its job. Let's come out and have that talk for a moment. Gotta have the talk. Explain why Pepsi is better than Coke. All right, market bottoms. Generally speaking, there are a few kind of checkmark qualifications, things we use. It doesn't make it perfect, and bottoms don't mean it's the bottom, just that it's a bottom, right? Semantics in English. But generally speaking, we want to see things kind of like this. We want one of those run down, everybody just can't take it anymore. They're puking out of their positions like crazy, and then something triggers and it rallies all the way back up, and you get some significant volume. Some oh damn volume. Volume bigger than anything else you have on any other level anywhere near where you're at. That's just one piece, but it is a piece. It's one of the pieces. Another thing for calling a bottom is that volume that we're talking about. You should see it everywhere. It should be in Apple calls. It should be in Amazon calls, Tesla calls. It should be in all the monsters of tech calls. Now, you don't have to be some kind of options nerd to be able to figure out that those monsters of tech products have accelerated or elevated or extreme volume, because Thinkorswim made that simple for you. All you have to do is look up here. Right? When this is when it's a new day, you'll have your sizzle, and sizzle just means 5-day average. So if we scribble out all this other stuff, if all you look at is the sizzle index, that's put calling and buy, put and call trading. A sizzle of 1 means we're at the average. We're just at the average, a 5-day average. Anything above 1 would say we're above average. And remember, we're looking for like, oh damn volume. So we want to see it, obviously, above the average. 3, 4, 5 above the average. And not just one name, not just Apple. You want to see it across the board, all the monsters of tech. Now, Thinkorswim's already reset, so we can't see what it was. That's not very helpful, right? But if we had looked at it yesterday, or if we even just go in and run some numbers, we can kind of discern. I give you the answer. We weren't seeing elevated call volume yesterday. So you don't have to go hunting for it. I already have the answer for you. It's beside the point. There's a whole checklist of things that we would want to look for if we were calling a bottom. And it starts with elevated volume. Now remember, the volume that we've spotted is today. So back there where I was showing you that hammer candle and that reversal and the big bar of volume, well, that's looking back what it looked like at the time on that day when everything was unfolding. Looked a little bit different. The main takeaway at the moment is that we are sitting in extreme volume this morning. All right, what I did here is turned on the TPO's time price opportunity. It's basically asking how long did we stay at a particular price point, right? Volume by time. And it's not much of a surprise that we spent the bulk of our time around the point of control. The longer we spend there, the more volume we collect there. It makes sense. The reason I turned it on, and it didn't do any good, but at least it would look, is I wanted to ask a question. Did we land in a large pool of volume down here? Because that might account for a large part of that volume that we had in the other indicator. We didn't, but we wouldn't know unless we looked. So what I was looking for here is if we spent a very small amount of time and yet we had a significant level of volume, that would have kind of indicated, hey, we barely spent any time here and yet we had all this volume, probably landed in a liquidity pool. That's not what we have, but I wouldn't know unless I looked, right? And that's kind of the idea. Instead, they kind of match. I mean, the curve's not perfect, but there's volume by time and volume by price at that low. So it's not like we wicked down in there and then came right back out of it again. All right. This doesn't look like capitulation. This doesn't look like fear and remorse. This looks like another day at the office. So until proven otherwise, I'm going to say we don't have any significant change on the day. Nothing is different. Nothing is changed. Keep your eye on Bank of Japan today. They've been defending that 105 level. They came out with statements saying they would not tolerate above 105. Well, I mean, they're working at it, but can they afford to keep that statement? We'll see. I think that's going to greatly impact the overall marketplace, and it's just one piece of the pie. Oil volatility is starting to come off a little bit today, but in the last 2 days, oil volatility just absolutely nuts, right? And we can swap that out and put in like the move. The move index would be bond volatility. Think of it like VIX for bonds instead of VIX for equities. And that's the volatility within the bond market in the last few days. I mean, that's crazy, guys. It went from 125 to 155 plus some. Well, what did the VIX do? All right, we're looking at something like that. It's a 30-point move in bond volatility. What did the VIX do? Not even 10 points? It's a dud. So I contend that this is not done yet, and that if something drastic or extreme is going to happen, we're certainly setting up for it today. One of those that might be an inclination, kind of a little heads up ringer, would be VIX above 35, GBP breaking back towards parity again, Japan breaking back above 105 and being unable to defend it, knocking it to take it back down again. I don't think gold's going to have anything of a signal. Bitcoin dropping down to around 16.5. Be a nice little heads up today that things are starting to get pretty nasty. We are setting up for a TRB, but we don't have one yet. And I think what we're going to get is a bit of a, or what we need to get would be some sort of capitulation dump first. Now, I've mentioned it before, I've talked about it before. When it comes to double bottoms, even really big double bottoms like this, so you get price come in, you set that low, and you move around, you got everything going on. When you finally come back down to this low, the way that IBD likes to teach it is that a good double bottom should not stop at the previous bottom. If it does, you should really be concerned, because the liquidity is down here. The liquidity is always on the other side of the pivot point. That's why you never want price to stop at a pivot point. It should really cause concern when it does that. The reason you want it to go lower than the lower pivot that you had before is this is designed to trap traders so that when it does begin to go up, it's squeezing all those shorts that jumped in after it broke lower than the previous low. If it doesn't break lower than the previous low, then those shorts jump in it, no shorts get trapped, and then when it comes back up, those shorts having to buy back to get out isn't adding fuel to the fire to make it really rip to the upside. This is absolutely a trap play. So when we take that back to our current market environment, we're at that low, and we've been stable at that low for a few days. That's a little bit of a concern. And then we still need the follow through, right? First it needs to go lower, then come out of it. If we rewind that a little bit to this double bottom, when we came back down to that double bottom, there was no pause, no hesitation, no basing pattern, consolidation, nothing. It came running at it like a brick in water. Trapped those shorts. That was not a trap recovery play by any stretch of the imagination. By the time it played out, they had plenty of time to get out. So I wouldn't see that as a trap play. But still, look at the double bottom. It went lower than the previous low, built its base, consolidated, and came back out of it. Now here we had some consolidation at that double bottom. Big, choppy, violent, took what, 2 weeks just chopping around, and then it finally broke a new leg. And now we're into this one. I would say that the current double bottom looks a lot more like this double bottom. For real. It looks more like this one and not like this one. Right? Especially with the way that we legged down through here. All right, there is something called a five bar rule. Today's bar is off the table for the moment. Take that off of there. 1, 2, 3, 4, 5, and then 6 was the doji bar. Now on the NASDAQ, I believe that's a green bar. But the 5 bar rule kind of comes into effect, suggesting that we're going to see, or should see, some kind of pause, some kind of reversal back up, a 1 or 2 day little bounce before continuing on. Here we are on bar number 6. An argument could be made that this first bar where we broke through the 4 is kind of off the table, so that would then be 1, 2, 3, 4, 5, and here we are on the 6th bar. The idea here is this should be a bar where we make a significant low and then rally back out of it, leaving a really long, like a pin bar or a hammer, something that looks like one of these. Or it could be the day where we finally break this double bottom and start legging down into the next lower levels. It's a significant day. While we're out here, the purple lines are the 200 period moving average. Now we're on a weekly chart. We've broke through one of the 200s. What I did here is I put both on, the EMA and the SMA, because I kind of got tired of the argument of should we be watching the 200 EMA or should we be watching the 200 SMA? Just put them both on and solve the problem. Realize that there are two groups of people out there. One wants to use one and one is going to use the other, and they are diehard fans. They won't change, and they are overwhelming in numbers. So we need to plot that one on the chart. It's 35.86. You can just use a drawing tool if you don't have an indicator that can plot that on the intraday. $35.86. Now it's a really interesting number, 35.86. If any of you spend time on Twitter, you may have seen it. It's the Goldman Sachs has an SPX collar down there. 35.86 exactly is where that collar is. Now, I don't want to spend time kind of digging through Twitter, but I made this Twitter package, this Discord that goes out and gets Twitter alerts, and I've recently rewrote it to include a lot of fund managers. And I mentioned it this morning because one of these fund managers last night posted a whole thread about that JP Morgan collar, what it is, what it represents, how you can use it in your trading analysis, how it plays into the GEX, DEX, and gamma levels, and how those can be magnetized. I'm going to have to just put it in the description later, because of course now that I'm looking for it, I'm probably not going to find it that easy. So if someone will just remind me later on, I will get the link for it and put it into the description of this morning briefing. So we're looking for significant change today. If we don't get it, I think we're just going to continue this chop, right? It's like the market is looking for a catalyst, and I really think that that's what it's going to take. So one thing that I would recommend is to focus on the big picture. We've got our low of the day. If we are to break below the low of the day, measure all of it from its highest point to its lowest point. That gives you 50% of the move, and then 100% of the move. 50% of that move lines us up with the ADR. The ADR is 2.46, basically 2.5%. That's 35.81, right below that JP Morgan collar. And then 100% of the move would be 35.50. Right now, we are flirting with the level of yesterday. The lowest point of yesterday is basically what we're sitting on. It's that red line that I have right here on my screen. That's yesterday's low. Now, we've crossed through yesterday's low so many times this morning that it has no value at this point, right? It's worthless. It's been played already. So we wouldn't look at it for any sort of support or resistance or pivot touch play. Nothing. It's worthless. Same thing with VWAP. We've been up and down through VWAP multiple times. This really looks like there's an active program. When we're getting too far from VWAP, it activates, selling us back to the mean. And then again, when we get too far away from VWAP, it's activating, buying us back to the mean. There can be multiple institutions doing multiple things at the same time, right? When you have a consistent market message, it means everybody is trading in the same direction all at once. Nobody's going in the other direction. Those are real easy to see looking back, but they're really hard to see in real time. So for an example, this day, obviously not the big bar, but this day, especially this afternoon, that afternoon right there, nobody was going in the other direction, right? There was absolutely no buying program out there. No institution, no firm, nobody. Nobody was trying to go long here. And yet, when it looks like this, Some institutions are going long and some institutions are going short, and they're kind of just passing it back and forth between each other. It's two-sided trading. So in the big picture today, we want to see a significant breakdown. We've got the volume, right? We got the volume. That's a lot of volume, and we haven't gone anywhere, which really kind of sounds like they're pouring gasoline on a fire, and yet the fire didn't get bigger, right? The violence isn't here, the volatility isn't here, the movement isn't here, just the volume. I guess the analogy would be like one of those wind-up toys, right? And the more you wind it up, the farther the toy can go. But right now, it's just winding up. Certainly implies that a big move is coming. Now, it doesn't have to be negative. Volatility means movement, not downward movement. So it most certainly could come ripping up off of these lows today. I don't see it that way. But we don't want to say that price can't do something. So in that, we've already talked about the downside. In an upside move, we would focus on breaking through our own Globex high, which is right at the daily pivot, 36.77. Challenging the cash open of yesterday at 37.7. We got a cog line at 37.11. That's also the ADR half, 37.33, the high of yesterday, and then 37.58, which is the ADR full, right? That 2.6%. Then we have the weekly pivot point. We're looking at a 10-day, 30-minute volume profile with TPO. If we were to start making that move to the upside, 3,700 or the cog line at 37.11 still has a significant level of volume. That's going to be a hard resistance point to get through. Now, econ can push us through it. Absolutely, econ could do that, but we don't have that kind of econ on deck. FOMC meeting, unemployment numbers, CPI, PPI. If we had something like that, econ of that nature could push us right through that 37.11 zone. But without that, I mean, it's going to have to be some kind of news or, I don't know, something else. So certainly something to keep in mind, right? If we do get above 37.11, we got a nice shallow area up to 37.80. You get through that, it gets shallow again up to the point of control, 38.74. Now, we're talking days away at that point, right? Because it's very unlikely we're going to make that move in a single shot. That's a TRB setup, by the way. Right, so we're priming into a TRB, preferably getting a TRB with something like an IX10 or an inside day breakout. So there is a long play coming eventually. But don't try to jump the gun. And I continue to see people buying YOLO calls and, Tina's. Come on. Just go to Vegas if you're going to do that. At least you get free drinks. Otherwise, if you're looking for a long opportunity, let it actually flip over and start making that move to the upside. It's got a long ways to recover if we're going to see something like the March rally or the July-August rally, those dead cat bounces that we had back there. If it's going to be something like that, waiting a day for it to turn around can save you a lot of money and give you a much greater follow through, and you're not going to miss anything. The July-August rally was like a month-long rally. You're not going to miss it by waiting a day. And swinging in the futures, it doesn't have to be the ES. If you're going to swing long in the futures, there's the new smalls exchange. You can use those, or you can just use the MES. Just remember the amount of buying power you need going into the close with an MES. It goes to full size. So you might need $55, to day trade it, but if you're going to hold it into the close, you're going to need the full amount. $1,430. Well, I mean that's Thinkorswims, and I'm I don't trade on Thinkorswim, but if I was trading on Thinkorswim at the MES, I'd need $1,400 to hold that thing into the close, or around about there. And obviously, I mean, if you're looking at it and you're like, well, I got a $2,000 account, probably wouldn't want to do it with a $2,000 account, right? I mean, that you got to give yourself more room than that. So it's kind of like that price tag quote that people say, when like, well, how much does it cost? Oh man, if you have to ask, you obviously can't afford it. If you have to look to see how much margin it's going to take to hold that little micro into the close, you probably don't want to do it. Use the new smalls exchange. They're perfect for this, right? I mean, really, they're absolutely perfect for it. But we don't have the rally yet, so we're kind of getting ahead of ourselves a little bit. We don't have the base. We don't have the capitulation. Certainly don't have the buying coming back in. The volume that we've seen today didn't go anywhere. We didn't rally up with it. We don't have the reversal yet. So let's get that first, right? I do like that they're unwinding 25 points, right? And that might have started happening in the very last part of the day yesterday. You know how we came up off those lows in the late afternoon yesterday? That could have been part of this getting started. If they're going to unwind more of that today, we could see the market start to kind of buoy up a little bit because of that. So that's a little check mark for why we could expect a positive move today. Then there's the 5-bar rule. We could put that on the table. But at the moment, I think any rally from our current location, unless we get, like a capitulation play, any rally should be sold, right? It's sell the rip, not buy the dip. And there's been some really great research coming out on how 2022 is the worst buy the dip year that has been around in, like, I don't remember how many years, but in forever. And one of their benchmarks was after we had, say, a 1% down day and people were going to buy the dip, what did the market do over the next 5 days after that 1 day drop? And in 2022, the answer has been go down another 1% on average. So buying the dip has been a really bad idea this year. Not a surprise, right? I mean, they were even talking about it in their retail letters at JP Morgan to their clients and customers, or maybe it was Goldman Sachs. I can't keep track of all the minions. All right, so make it really easy on yourself. Focus on outsized moves. Avoid the chop. Avoid, the same thing that we've had over the last few days. We want to see a break below our current low with conviction, with size. With all the fear and the angst and the hands wringing and, it's all over the social media and like, it's all going to end. We want to see capitulation selling, everybody puking up their positions, massive moves. Something that looks like that. And if you're talking on the bullish side, then we would want to see something that looks like that. Right? Simple, easy. You can avoid all the chop and the stress and the mess and just focus on that. And it really is about the yields right now. So, I mean, I can't stress it enough. You got to watch the bond market. Keep your eye on the bonds. Keep your eye on the Forex. That US dollar Japan one right now is like the most critical just because they've basically drawn a line in the sand and price is headed right for it. I mean, we're at 144.70 and the line in the sand is at 145. The move index, which is like volatility for bonds, just absolutely extreme. VIX slipped into backwardation the other day. So you look at the active VIX, we're at 31.75, and that's for October. So then you slip out to November, 30.90. So the active at 31.70 is higher than the 30.90. That's backwardation. Now it's a little uncomfortable, or it's not fun trying to do it this way. So one thing that you can do is if you go back to chart and go to product depth, put the VIX in. There's your VIX. Now, if you get rid of all the fancy nerd talk, backwardation and contango and all that funny language, this curve should move from left to right, moving higher as you go farther out in time. That would be normal, and that would be contango. It's what we normally stay in, contango. When things go wrong, the front end gets more expensive than the back end, and the curve goes from high to low, left to right, instead of low to high, left to right. That's backwardation. And it greatly affects options trading, but a lot of other things too. There's these companies or institutions or funds, they're VC funds, volatility control funds. Those volatility control funds can be high vol funds or low vol funds, but they've got metrics designed that tells them when they have to allocate capital into the market and when they have to take that capital out of the market. They don't get to pick and choose. So when volatility hits a certain level, they have to perform this procedure, whatever it happens to be, buy side, sell side. Now, knowing where their levels are gives you a really indication of that under the surface non-stop buying pressure or selling pressure. Right? When everything should be going up and yet it just keeps not going up because there's that under the surface selling or buying in breadth. So VIX controls all kinds of stuff, not just the options market. Another thing about a rally today, or the potential to have a rally today, going to need this dollar to get down below the consolidation or base here, so below 113. We'd want to see the VIX drop too, say below 30 at least. This would be a good start. Just seeing a rally by itself isn't going to be enough. don't think this is the chart I'm looking for. That's the chart I'm looking for. All right, so VIX at least below 31. 30 would be better. And the dollar back below 13.5, 13 flat would be better. If we're going to see a rally in the S&P and the NASDAQ, we want to see those two first quit advancing and second start to fade off a little bit. We do have a head and shoulders, or an invert head and shoulders this morning on the S&P and the NASDAQ. And if you measured them, it would get you back up to the orange line that you see here. That's back to where we opened last night. That's basically recovery. Just getting us back to flat if the head and shoulders actually played out. And it's really wide. It's really ugly. It's almost like a wadded up, chewed up bubble gum. And that's not a good pattern to follow. Right? The uglier the pattern, the uglier the follow through. So we keep talking about what a good day would look like, or what a rally would look like. Keep in mind, that's not the base case argument. The base case argument is that we're going to either hold the line again today, or that we're going to break to the downside significantly. Mr. E, thank you, sir. So someone just gave a shout out that Bank of England news just came through. That's the worst thing about doing a morning briefing at 7:30 to 8:30. Oftentimes, that's when ECB is having pressers. So we keep talking about the positive thing that could happen today, but remember, that's not the base case, right? The base case argument is that it's going to be a significant downward move first, that it almost needs to be a significant downward move first before anything else. There are flash crash warnings now. We're already down 0.25%. We've got an ADR of 2.45. If things got nasty today, we could easily make, a 4% move, right? So a 4% move would get us down to 35. That's not bad. That would be splitting the difference between the pre-COVID dump and that first reversal after making it back up from the pre-COVID dump. All right, I'm going to leave this here for a second so you guys can take a screenshot. There's some levels to the downside that line up with gaps that aren't filled yet. Of course, the upside gaps that aren't filled yet. Now, a little bit of perspective on the week. This is the expected move for the SPX. The weekly expected move, 35.68, is the downside expected move. For the ES futures, it's 36.06, basically that 3600 area. So we're not even outside of the weekly expected move. That's not negative. That's not extreme. That's not in any way getting out of control. It's hard to see a rally coming in if we don't get that. All right, looking at the sectors that are doing good this morning, the benchmark is 0.5%. We've got gold, energy, healthcare, oil or crude, more gold, and biotech. And then for things that are not doing good this morning, semiconductors are the worst, and they have been the ones that still have a lot of room to fall. I seen a statement yesterday that really kind of resonated with me. It said, if they're not buying Apple, why would they buy anything else? Right? And if you think about that a little bit deeper, kind of get past the surface off the cuff remark, Apple is the thing. It's in every single mutual fund, retirement fund, pension fund. It is the fund product. Everybody wants it. Everybody owns it. Everybody has that in their long-term portfolio. And if they're not buying Apple, the best thing on Wall Street, the darling of Wall Street, why would they buy anything else? Worse, if they're selling Apple, if they don't even want to hold that anymore, and they're unloading Apple, why would they rotate into something else? You think they're going to rotate into some no-name trash speculative tech company? You don't get out of the darling of Wall Street to go buy a turd, right, or a zombie corp that probably won't even survive now that the liquidity is tightening up. So think about things that are still shortable, that have not had a haircut of over 50%. Things that don't look like PayPal and Netflix and Baba and Baidu and JD and Zoom, like Tesla and Apple, Microsoft, and certainly semiconductors. They have a lot of room left. All right, I was digging through emerging markets more. The EEM, I've talked about this. We often use it as a gauge of global risk on sentiment. It's more than that. If you start digging into the basket of what it represents, this is a whole lot of Chinese companies. Now, I was under the impression that China was no longer considered an emerging market because it has already exceeded like the benchmarks required to be considered an emerging market. And yet apparently it still holds that classification. Or this has not been rebalanced yet since that classification has changed. Either way, EEM still represents a boatload of China names. So it's not just global sentiment the way that we've been using it. It's also a representation of like the China names. Now, KWeb is like China Tech. So another representation, the same thing. Probably going to end up adding that to the list for what we go through when we're trying to figure out, beyond the 9 or 11 legacy S&P sectors of what's doing good and what's doing bad on the day. But finance is not down as hard as I would have expected this morning. Certainly doing a lot better than technology. And energy is more than just XLE, it's XLP too, right? So, and crude. So kind of across the board in all different aspects. That's a heck of a gap down. So what we're doing here, I'm kind of poking around, seeing if there's anything like a short covering rally even beginning to show up out there, and I'm not seeing anything like that. A short covering rally would have enough fire or fuel for the fire to kind of rip us to the upside a good 2 or 3% on the day. And after the drop we've had over the last week, it's not an unwarranted perspective, but there's none of it coming through. All right, so if you look at the FANG names yesterday, or the monsters of tech, that significant, just absolutely massive, explosive move. But we didn't have it in finance yesterday, right? Finance kind of came out the door, tripped on its own doormat, and down it went. Never got across that line in the sand. From the high off of the 23rd, right? That's been the line on Monday and Tuesday. We just haven't been able to breach, and then of course down we went. This morning, finance is doing better than technology is. They're both down, but finance is down less than 0.5%. and tech is down nearly 1%. And I'm looking down here in that afternoon. So this is the NASDAQ. Could have swore we flipped those over yesterday. Put the FANG on the same side as the NASDAQ breadth. Put the finance on the same side as the S&P breadth. So we had divergence in the tick. And we had the advanced decline get back above the zero line from just this little bit of tech rally. Green line crossover yesterday afternoon kind of signaled that or validated that run up off of the low. I think it's going to be tech today. If we can lose it and get this capitulation out of the way, we could have a really good week next week. We got to break those levels. So a downside move today, guys. Focus on that JP Morgan collar first. It doesn't matter if you're looking at the ES or, their collar's not on the ES. But the numbers, they're not too far out of line. It's 35.86 in the SPX. That's where that collar is at. Right, and I paused the screen earlier so you could take the pictures of the downside gaps that aren't filled. And we've already walked through the levels, so you should be good to go. Remember that we're looking for some sort of capitulation reversal play. If things get really nasty today, you're going to see additional Fed speakers just popping up on TV, right? They'll be unscheduled, unannounced, and they'll use words and phrases that will buoy and rally the market up off of the lows. Just like we did when we first hit that 20% down, right? That was the benchmark that everybody was focused on from the 2022 year-to-date highs. When we got below that and hit the 20% off the highs benchmark, it was a Friday afternoon, and a Fed speaker just showed up on Fox Business and started talking, and we rallied, just this absolutely ripping rally to the upside. And that'll be kind of the signal you're going to be wanting to look for. Now, they don't have to show up on TV, but the plunge protection team is what we call that. When they come out, it's getting pretty nasty out there. So watch the volume, keep your eye on the levels, and for goodness sakes, be careful, everybody. I'll see y'all tomorrow.